Big banks in the U.S. are boosting dividends and stock buybacks, sending a clear sign of capital strength following the Fed's latest stress test. And just ahead of earnings season, our next guest says this is one of the most attractive entry points into the banking sector in decades. Joining us now, Stephen Alexopoulos, TD Cowen U.S. large cap bank analyst. Stephen, great to have you with us. It's interesting to say that this is the best time right now, considering so many banks have run up and are sitting at new highs as we speak. And so I'm wondering what you see as the next catalyst. It seems like there was very little reaction to the release of the capital plans last night, which indicates that everything was baked into the stock to this point.
Yeah, so to be clear, I'm not bullish on the sector because of what you heard related to the stress test. To me, that's small potatoes in terms of what we'll ultimately make in the banks. They run up. Banks are trading at around 10.5 times forward earnings. Long term, they've been about 13 times. I think we'll head 13 to 15 range. And Melissa, I'd like your viewers to think a little differently about AI. Now, when you think about where we are right now with AI, we're at the builder level, right? The focus is NVIDIA, the focus is OpenAI, the builders. I believe we're inside of 2 years, maybe one, where the focus will widen out from the builders to who is going to use this technology to unlock massive economic value. This is exactly what we saw on the internet, right? As the internet was being built, the focus was on Cisco, IBM. And then as the layer was built, it moved to Google, right, with search, and Amazon, right, selling commerce. And I think when you think about the S&P 493, this is what a lot of, honestly, strategists just miss. You have to say which of those companies are going to use this new technology, right? To think that the Mag 7 are spending all this money on AI to have a $20 a month chatbot is insane. They're building a technology that there will be 100 of me that I'll be able to leverage in the future. So what does that mean? You need to focus on sectors that are reliant on people, right? Knowledge workers. That is what will be disrupted with artificial intelligence. Now, if you take all of the sectors, the number 2 sector out there that's reliant on people behind the scenes who look at information, pull information, send information, it's banks, right? And just at the JP Morgan Investor Day a couple of weeks back, Marianne Lake, head of the consumer bank, talked about, think about this, in the next 5 years, headcount in the consumer bank will decline about 10% from where it is today. Business growth will continue. The headcount will come down. I worked at JP Morgan for 18 years. It's conservative with their estimates. That's probably going to be 20%. This is not linear. This is hockey stick, right? So when you think about who will benefit from artificial intelligence taking out massive costs out of the back office, once that conversation starts, my sector is going to be on your news channel very frequently. And then people are going to say, which of these are going to benefit the most, right? JP Morgan is leading, but they're all following on this.
So you're starting the conversation now. So let's have it. Let's use that example of JP Morgan. If you actually apply that and assume that headcount is going to come down by 10% in consumer, and you've got the same growth trajectory, what does that mean to its valuation? I mean, we're talking about JP Morgan, which I think has the highest price to book in the group. It's like 2.3 or so. So, you know, on a valuation basis, it's richly valued relative to itself and its peers.
Melissa,
so how
it's only richly valued relative to history, right? And that history did not include the most transformational technology of our lifetimes. Banks will break to a new valuation paradigm. Everybody who's a historian that looks at, well, banks were trading here, we think they'll trade back there, they're missing this. This is a transformational technology.
Should it be 3 on a price-to-book basis? Should it be? I mean, what?
Yes.
What kind of?
This will be by the end of next year. This will be $1 trillion market cap company. And by the way, as JP Morgan goes from 15, 16, 17 times as they're leveraging AI, their bottom line. Think about this: the earnings growth of JP Morgan will be comparable to the S&P 500, and they're also using AI to reduce risk. Right? AI is being used as a tool with credit decisions, portfolio management, and it's being used as a tool to improve customer experience, right? One of the other things, I don't know if you caught this in the Investor Day, they talked about they're now moving out of pilot phase. Every customer on their mobile app is going to get a personalized landing page, AI driven. So, Melissa, if I told you banks historically traded at 13 times, that was the average over 20 years. But now we have a technology that's going to take out massive cost. It's going to reduce risk dramatically. It's going to improve the client experience. And I said, okay, we're still going to trade at 13 times. That would be ridiculous. We are going to break to a new paradigm upside, right? Not to mention deregulation is helping the banks. Net interest margins have bottomed. That's going to help the banks. So you said I'm the most bullish in years. The only other 2 times I've been this bullish on the banks were coming out of GFC and then after the regional bank crisis. This is one of those opportunities.
You may very well be right. And for those who are in the banking business, I hope you are. But my question for you is, AI largely is a disruptive technology. And you would also imagine that while it would help bring down the headcount and create the efficiencies that you're describing inside banks, it would also help competitors be able to actually replicate and create lots of banking-like services, even if they are not regulated banks. And so I'm curious how you think about that, how you think about the margins that exist within, frankly, some parts of the financial system that may get undone by tokenization and some of the things that are taking place with crypto and everything else.
Okay, Andrew. Well, crypto is a different story. So I'm very bullish on the sector as it relates to AI and the benefit to the entire bank sector. Now, when you talk about stable coins, right, with the Circle IPO doing what it did and the Genius Act getting passed, that was the Steve Jobs moment when he held up the first iPhone in 2007. This is going to completely transform banking and payments as we know it today, right? The way business to business cross-border payments work today, it's like when you used to have switchboards and people would try and call the other half of the country and you go through 6 switchboards. It's usually inefficient, it's very expensive, and the customers don't like it. This stablecoins will transform the payments business, particularly cross-border. That's why I am, even though I'm very bullish, I'm cautious on a name like Citigroup, because Citigroup's crown jewel business is this business, cross-border. Payments overall about 7% of revenue for the large banks. That's what we're very focused on. So 7% potentially at risk. I think over time, stable coins will overtake non-interest bearing deposits. If you're a CFO, I can't imagine, even you hear banks talk about tokenized deposits now. I'm a CFO of a company and I could keep my company's capital in a stable coin, which was reserved back 1-for-1 versus a deposit or tokenized deposit, which is lent out or invested longer term. I'm going the stablecoin route.
Right.
So that's a different argument. And there I am cautious.